I would like to do today is to take you through some analysis that we've done on adverse selection, the causes of it. Some of this analysis is older, goes back to the 2009 mortgage crisis. But as we see conditions changing today, it looks very timely. So we'll talk through some of that. Now, what do we mean by adverse selection? Often this has several different sources. One of them, what people most often think of, is the competitive adverse selection. And this is where competing institutions, as they change prices, may draw better than average or worse than average customers to them. And in general, that's what we mean by adverse selection, that you're not getting the credit quality that you think you should based on your models. And these distributional shifts can happen for, I think it's another assumption here that adverse selection means the distributional shifts are happening in ways that you cannot see from the normal underwriting criteria. So in addition to competitive, we tend to focus on the macroeconomic causes of this, where you get broad shifts in consumer risk appetite. The biggest causes of that being changes in interest rates, changes in collateral values like house prices, auto values. So when those things happen, it changes who's interested in getting a loan. This can be caused by underwriting shifts, which may cause riskier borrowers to be brought on. And we're also a bit concerned right now about score inflation, that this is a little bit unique, but through the pandemic, when the government was providing direct assistance to everyone, that assistance did not incorporate any kind of a score or measure of being deserving. Everybody got the assistance. So the issue is that if everyone is able to pay off their bills temporarily and their bureau scores rise, that doesn't tell you long-term about their willingness to pay or future ability to pay. So it definitely can impact the predictability of score measures. So we'll look at some of this. The first thing I want to look at is just mortgage interest rates to give a little perspective. You can see on the right, I updated this data yesterday. So most recently, mortgage interest rates are approaching 5%, which is interesting because the last time we were getting in this neighborhood, back around 2019, we were also seeing a dramatic slowdown in mortgage originations and concerns about a possible recession. And you saw the Fed do an abrupt drop in interest rates before the beginning of the pandemic to make sure there wasn't a recession. Now that we have so much inflation from supply chain constraints, oil prices, that sort of thing, the question is, what's the Fed going to do? The Fed has only a few pages in their playbook. And so raising rates to fight inflation is, of course, one of their key plays. But if that inflation is being driven by supply chain issues more than the usual economic cycle, then they may curb inflation but spur a recession. It's not clear in this situation that they can get the optimal interest rate for both at the same time. If you look at the change in interest rates, this is what's really going to be telling, because consumers care less about the absolute level of interest rate. They care more about change in interest rates. And because we get accustomed, after a certain amount of time, we get accustomed to a certain cost of borrowing, a certain cost of living. And so it's sudden changes to that which registers. And what you see here is that the increase in interest rates for mortgages that's been happening over the last year. This is a year-over-year change. So obviously we've got a significant year-over-year change right now in interest rates, comparable to what we saw back in 2013, a bit like 2019, and interestingly back around 2006. This 2006, 2007 period is important to pay attention to because we'll want to compare to analysis we did on what was happening back then. Now this graph is messy, but it's actually very accurate. So if you pause and let it sink in, what you're seeing here is the Senior Loan Officer Opinion Survey for mortgage demand is the blue line. This is an index of the percent of lenders surveyed who indicated that there was more or less demand than the previous period, and it's a quarterly survey. So if it got to 100%, 100, it would mean that everyone reported more demand. Minus 100 means everyone reports less demand. And on the right-hand axis, we found that the best correlation to this, in fact, anti-correlation, as you can see, is the 2-year change in mortgage interest rate. So if you look in here, in the early 1990s, 1995, into 2000, 2005, 6, 7, in the mid 2000s, each one of these periods, there is some noise, but in general, there's a very strong anti-correlation. And you can see that anti-correlation even around 2018, 2019, 2021. And now, of course, what's happened, we don't have the newest mortgage demand survey, but we do hear that mortgage originations are already off 40% in the last month compared to previous periods. And obviously that's due to the sudden rise in interest rates. So if I compare these graphs, the number I want to keep in mind is that with interest rates rising about 1% over a 2-year period on this scale, that would come in at something like a plus 0.5 on the left-hand axis, meaning that when we do finally get this index reported, probably we'll have a plus 50 indicator. Now, the reason I want to remember that is that we did a survey, and I don't know if Jose Canal Cerda could join us today. He was my co-author on an analysis that we did of the US mortgage crisis. He was at the Philadelphia Federal Reserve, so we were able to use data that they had at the time to look at estimating credit quality. That's the blue line. And on this scale, the way it works is that low is risky, high is less risk, kind of we flip the axis the way you would see with a FICO score, so that up is better and down is worse. If you overlay that against the mortgage demand that we were just looking at, here again, we get a very strong correlation that periods where demand is high, you also get good credit quality. Where demand is low, you get poor credit quality. Now, I'll pause and let's think about what that means. Basically what we're saying, and this, we analyze this, we have a paper on this you can look up, where we sliced it by FICO score and as many different things as we could in the data that we had. This was independent of all these. So you could take a single FICO score. Let's say you had an applicant who had a 720 FICO score. For that constant FICO score through the credit cycle, the variation in credit risk was this dynamic. And the scale on the left-hand side is units of log odds of default. So a value of 1 is roughly a doubling or sorry, a value of -1 would be an increase in risk by a factor of 2. A value of +1 would be half as much risk, roughly speaking. And so the idea here is that there's a very dynamic oscillation in credit quality for a single FICO score. Now, the way that happens is that I'm not picking on FICO score, really any underwriting criteria or combination you might have. You come up with a combined uh, underwriting score that you have. What you really have is a distribution. You don't have a single borrower characteristic. You have many borrowers, many people who happen to have the same score. And so that's a distribution of risk. What happens when demand is low is that you're not uniformly reducing demand. What you're doing is reducing demand from the least risky people within that distribution, but least risky in a way that we can't measure. The best way we found to explain this is that it comes back to a personality measure, which is exactly the kind of thing we don't have in bureau data. What we see out in the world is that there are really two kinds of buyers, two kinds of borrowers. You have value shoppers, people who only are interested in buying when there's a good deal. So that's when rates drop and you get a big wave of refi, or people suddenly getting interested in new homes. Or we see this effect in northern states with auto lending, where in the wintertime, you get much better credit quality for the same FICO score, because anyone who's willing to go stand on a frozen car lot and argue over price because they know the dealer needs to move a car in December, that is a very financially aware borrower, as opposed to impulse buyers. Looking again at auto lending, the person who will buy a car because on a sunny summer afternoon they see the cars washed and the balloons flying, that's an impulse buyer. That is not the financially thoughtful person who was out there arguing over price in the wintertime. So we see the same thing with home buying, that when interest rates fall, and this 2-year period was, again, optimal. So I don't know if this relates to when things get coverage in the news, but somehow this 2-year window is when people pay attention. And so if they see a drop in interest rates over a 2-year period, or if they see a certain amount of home price appreciation, this part was nonlinear, that if home prices are falling, the good consumers don't want to buy a home. If home prices are rising too fast, it also scares out the financially conservative home buyers. The best home buyers want a modest rate of appreciation in a decreasing rate environment. If you have that, you're going to get much better quality than average. When you don't have that, demand will fall and you'll get much worse quality than average. So that's what we saw in 2006, that if you look at this blue line, we crossed average around 2004, 2005, depending on where you draw the average line. By 2006, we were booking much riskier than average loans. 2007 is when it got to be the peak of bad quality loans. And then suddenly, around the beginning of 2009, when the recession hit, that snapped back. Now, this axis here is origination date. Okay, this is not default date. So bad quality loans being booked back in 06, 07, 08, the recession was playing out in 09 and 2010. And what that meant is that in the recession, you had the bad loans. And if you look at these previous cycles and ask where was the recession each time, you'll find the same thing, that the risky loans are booked right before the recession because the Fed raises rates to fight something like inflation. 12 to 24 months later, you tend to get a recession, but during those 12 to 24 months, you tend to book risky loans. because the conservative consumers stay home. So the question is that going to happen today? If rates have suddenly gone up so that demand is suddenly falling, and on this scale, if demand is going to be at a minus 0.5, a minus 50, that would translate to about a minus 1. So it could mean that, at least over this next quarter, where rates have already risen, that credit quality could be half as good as what we're used to. Now, we're already raising rates. So if you said, well, if quality is worse than we expect, maybe we need to price for that. At least we should be asking that. But if we're raising rates already and then we raise them again for the increased risk of those willing to take the price that we just set, you've got kind of a vicious cycle there. Probably the more careful response would be to be cautious about the volume you book in a raising rate environment, and to monitor adverse selection. And so that'll be the next thing we talk about.
So Joe, quick question
Yeah.
here. So you've related this to out of your APC model. There's also, you mentioned pricing, and in particular the pricing cycle, which is that on the credit decision side, people reduce their credit quality because the demand will go to other lenders who have low, and so it drives the whole market down in terms of credit quality. And I know in your paper you talk about that. Does the at this point, have you sort of taken that out, or is that part of, I mean, you're focusing on interest rate here, but is that also potentially part of what's driving this relationship?
It's a good point. And in this paper that's listed below, you will see a discussion of that. What we did was, the blue line here is a total credit quality measure from an APC type model. You're exactly right. We also built a score, which was, in fact, it was a survival model type score, where you've got APC inputs, which means life cycle and environment, and then you've got scoring attributes. So the point of that paper really was to account for everything we could measure: FICO, LTV, borrower purpose, and there was a few other things listed. Once you've accounted for each of those things, what was the residual credit quality? And what you'll find is that of this deterioration that happened back in 06, about half of this was a race to the bottom by borrowers trying to keep volume up in an increasingly competitive environment. The other half looks attributable to consumers, a pullback of the interest rate averse borrowers. So you could say, the way we look at it, yes, half of the mortgage crisis was the fault of the lenders. The other half was just that you couldn't find good consumers even if you did it right.
Got it. Thank you.
And then this is just a repeat of what I was just saying. If you put these things together, if history repeats itself, then we are seeing the fastest increase in rates since 06. With an increase this fast, we could definitely see a dramatic fall in mortgage demand, and that's what we're hearing. And given that kind of fall in demand, we need to consider the possibility that risk of default could significantly increase. Now, this is, roughly speaking, you could call that an increase in PD of about a factor of 2. Now, that is big, and what we have found historically is that the oscillation in credit quality due to this underwriting index. If you look at the scale here for the variations in credit quality, this is a bigger range than what you get if you compare to a comparable measure on economic impacts. That, in other words, the credit quality we book is a bigger driver of future losses than the economic environment, or at least as big, depending on the portfolio. But this is dramatic, even when compared to recession impacts. And being able to say that is one of the advantages of that age period cohort type of analysis. So before I go on from this, Leonard was right. This is a great place to ask questions. Anyone have any?
I guess just that last point about the potential 2x increase, that would be for mortgages initiated during the interest rate rise.
That's right. And so, and it's saying if these live through an economy that's basically flat from here, that it's a 2 times increase. Of course, the added risk is that if raising rates slows the economy and triggers a recession, and of course, with all the supply chain problems, there's a risk of recession anyway, then it could be worse than 2 times, because it may have an overlay of a recession as well.
I have questions, but first of all, thank you so much for this first one. Really interesting. But so here you look at where it comes to mortgage loans. Sounds a little off. Is the effect extra pronounced when we talk the mortgages with sort of wide selection of consumers use, if we compare to, for example, unsecured consumer loans, which is more used by sort of lower credit quality customers?
Okay, great question. So first of all, on mortgage, we did look at this, whether this happens for all credit tiers, subprime, prime, super prime. The answer is yes. You do see this effect for all credit tiers. So this, even if you're looking at subprime borrowers, there are those who they're subprime, but they're still financially conscientious, as opposed to subprime and not conscientious. There's a distinction. So you see this self-selection effect everywhere. As far as going beyond mortgage, now I don't have the mortgage data set, of course, is a nice public data set that everyone uses. Looking outside mortgage, I don't have public data, but based on our internal analysis, I can tell you that the credit cycle effect that I just showed is about half as strong in auto lending, and it's about half as strong, again, in unsecured personal lines, personal loans, credit cards, that sort of thing. So to me, what that means is that people are the most financially aware when it comes to the biggest purchases. Mortgages where they pay attention the most, and they are most dynamic in their decisions relative to interest rates. Auto, halfway as much. Personal lines and credit cards, not as much, but there is still an effect. And so if I remember, with credit card, it was kind of a plus or minus 20% effect instead of a plus or minus 100% in terms of credit quality.
Thank you so much.
This actually sort of, I have to smile a little bit, because when I first got involved, it was the early 2000s, and trying to sell credit scoring for our whole loans division. And they were doubtful of using the scoring models. And something that we picked up was that the people who were being assessed seemed to be better at practically assessing their own creditworthiness than the models that we were applying. So you're basically confirming that through this, or it's sort of further evidence.
Yeah, and it does say that I am old enough to remember, at least from, maybe I'm just remembering as a kid, that when my father would go ask for a loan for something, the first question was always, why do you want this loan? And purpose of getting a mortgage is still on the questionnaire. It's not generally considered highly reliable, but some of those questions actually may have value here, that if you could get into a conversation, but then you wind up back into more subjective lending, and that has all kinds of errors associated with it. So I can't say that we can do better than this, but I would say there are those who try to sell products where they try to assess how financially conservative someone is, because we do have different personality types within the population. And this impulse buyer versus value shopper distinction seems to be about 50-50 in the general public. And it can probably be measured in other areas. The question is, would it be legal, at least in the US under various laws? Would, if that correlated to anything that was a protected class status, of course you'd get in trouble. But I wouldn't be surprised if there were some ways that they could measure that. And for all I know, it might come from looking at what magazines you subscribe to. Of course, these days would have to be online subscriptions and whatnot. But yeah, not sure, but there's definitely a personality aspect that goes beyond what's in bureau data.
Just to add a little color to that, in the developing world, especially for microloans, that personality assessments do have predictive capability beyond what they've got as credit scores.
Mm-hmm. That makes a lot of sense.
And Ray probably knows a lot about that.
Yeah, and I think we've all seen presentations where folks use alternate data sources to try to get at that. Some data sources that we can't necessarily use in the US, but that social media and other things that I have no doubt can be predictive.
So just on that one, so my first foray into that realm was unsuccessful, and it kind of failed and cost my employers a hell of a lot of money. But the guys that are doing it have since carried on, are still doing it, and they've improved the processes of using the psychometrics and stuff. But just while discussing it, just to confirm, you mentioned 4 categories of adverse selection, and adverse selection is supposed to be the information differentials between the different groups, and normally that relates either to competitors or the information held by the borrower relative to the lender. Are you using that same definition? Because it wasn't quite clear that it was an information difference.
Yeah, in fact, I'm going to address that directly in my next little section here, talking about quantifying adverse selection. And it's very much what you just said. This is a good intro to that. The measure of what the lender knows, in my case, is going to be the model. So we're going to simply look at residuals relative to the model, residuals by vintage, to get an idea of some kind of an unobserved credit cycle. So first of all, just a little bit of what's happening today. This is data taken from our shared data pool, which is about 250 institutions in the US. And we do see, especially in the subprime categories, some increases in delinquency rates relative to what we experienced through the pandemic. Now, I wouldn't say that's particularly shocking. And again, this is portfolio delinquency. This is not just looking by vintage alone. And one way to say this is simply that the payments have worn off. That's not entirely true. There's still a lot of cash in bank accounts, but perhaps in the subprime category, the most, that money has been spent, and we're seeing a reversion back to pre-pandemic levels. This is looking at mortgage. We can also see some reversion happening in personal loans, and especially in subprime credit cards. If we do this analysis by vintage, we're also seeing a return to prior credit quality. Now, when we talk about looking by vintage, the kind of a universally standard approach for doing that is to just take data from pools based on origination date and start tracking things like cumulative charge-off rate, cumulative default rate. And so this graph is actually some real data that we used as an example. And you can see that the prior to the pandemic, you've got vintages back in 2018, 2019 up at a higher level. Vintages booked in the pandemic were much lower. And then just in the last half year or so, the newer vintages are accelerating compared to what we had seen before. And so we are finding, just on this kind of data, visually, that the newer vintages are coming in at higher risk. Now, this is a visual without explanation. So what we want to do is take this kind of data and break it down according to cause. Now, obviously, there's very little information on the most recent vintages, so the uncertainties are high, but the value of measuring that is also very high. So we tend to look, instead of charge-off, we would run the analysis on early delinquency, something like 60 plus delinquent or even 30 plus delinquent, and ask, is the first occurrence of 30 plus delinquent, look at that on a cumulative basis, is that coming in faster than what it had on previous vintages? And how does it compare to model? Is there an unexplained component of that? So the part of how does it explain to model, if you're going to do that, you do need a model that takes into account timing, because you need to be able to compare young vintages versus old vintages. So this is where, most of the people on this call have heard me talk before, and you know that I've been using age period cohort models for a long time. It's not the only way to do this. It's just the way that I'm very comfortable with. So that APC decomposition allows us to separate life cycle, credit quality at a vintage level, and environment. And then what we do is we build a score. Well, this is a visual of what that looks like first, that in fact, taking prior mortgage vintage data on the left, if you do a decomposition, these are the actual outputs that you get, where you can see the different life cycles. For subprime, it rises much faster and up to a higher level. For prime and super prime, the levels are lower in terms of the life cycle. On a proportional basis, they all live through very much the same economic impact. So it's essentially saying that a 50% increase in losses due to the economy is a 50% regardless of your starting point, whether it's subprime or super prime. The credit cycle on the right, you can see that there is a credit cycle for super prime, prime, and subprime. And in fact, the credit cycle is strongest in super prime as compared to subprime, but it is there in all three. So there's always a credit cycle. And it's this third graph, the credit quality, that we want to replace that with a score. So what we would do is set up a panel logistic regression. And again, for adverse selection, we would do all of this based on something like first occurrence of 60 plus, measure the life cycle, measure the environment, use those as inputs to a panel logistic regression model with whatever scoring data we have. And so for mortgage, that's going to, of course, be FICO, LTV, and hopefully other factors as well. We can do the same analysis for auto lending, et cetera, and get not only the scoring coefficients, but at the point, you can do this two ways. You can either make this model and then run it and look at the residuals by vintage, or you can actually include vintage dummies in here at the time that you estimate the scoring coefficients in order to measure how much unexplained residual you have relative to that score. And of course, if you have enough data, we like to look at those vintage dummies monthly. As you have less data or a lower delinquency and default rate, you have to go more aggregate. But when we've done this most recently, coming up with this measure of adverse selection, this is an example of this that we ran just in the last few months. And you can see, and I believe actually, it doesn't say here, but I'm pretty sure this was auto. And so what we're saying for auto is that compared to pandemic levels, of course, things are much worse in terms of recent originations than they had been, but much worse really only puts us back to about a 2018 level. Confidence intervals would be quite large here. So there's a lot of uncertainty in this estimate, but roughly speaking, credit quality looks to be back around 2018, 2019. This is not a disaster because most people didn't reduce their pricing based on continued pandemic levels. Most lenders don't assume that we keep getting checks from the government. So if it stayed at a level like we had in 2018, as far as residual credit risk, that's probably fine. But if this continues to rise, because these things do trend, and if it rises in addition because of increasing interest rates, then we may have more of a problem. Now, the rise that we see here in the second half of 2021, this could be more to do with a return to normal, meaning that the FICO score inflation, people performing better than their FICO score in the pandemic, that might have gone away. And we could see this increase now because of rising interest rates and that self-selection effect. So let me pause here on quantifying adverse selection. In a nutshell, it's pretty simple. We're putting in a dummy variable to capture residuals by vintage cohort. And you can do that in any kind of model, so long as that model also has some kind of a life cycle effect, so that you can measure this on accounts of many different ages. But any questions there?
Just again, a comment. You said that maybe we're returning to 2018 levels, and it may not be as much of a problem in mortgage, but certainly in credit cards and other unsecured lending, that people tend to build models on more recent data. And so they're or calibrated on more recent data. And so their models may be way out of whack, and therefore the decisions much more so than this would indicate.
That's an excellent point. And I think at this point, I should give a little advertisement for Model Risk Managers International Association. I was drafted into being president of that a couple of years ago. We have a conference coming up in June 2nd and 3rd. And that group put out a white paper back during the pandemic and said, basically, what are we going to do with data from the pandemic? Because it is not reflective of normal consumer dynamics. And the two conclusions we drew were that either you ignore that data because it's really not reflective of consumer behavior, or you go back and adjust that data and say, without payments from the government, without forbearance programs, what should have happened? And that should have, you can do some statistical analysis and say, well, I mean, it's a bit like reject inference. It's a bit like saying that for an external cause or kind of a selection process, some of the defaults that should have happened didn't. So if they defaulted after forbearance and assistance programs ended, then you could say, well, maybe they should have defaulted earlier. You could go back and reassign that. Or if they stayed strong and didn't default anywhere, you've got a different group. The third group in the middle is, there may be an ambiguous group where they should have defaulted, but they didn't because they were helped through. And that's the whole point of government assistance, is to help people through that. So the fact that we got fewer defaults than we should have in total means that there was some point of sending out the money. But it does make it difficult to get that calibration correctly done. And so there will be a panel discussion coming up at our conference about that. So you'll hear folks say, you know, what are they doing with that today? I know you're going to hear plenty of people say, well, we have no choice but to use that data because we get pushed to do it. And some products, as you say, are very dynamic, very much focused on near-term behavior. And I think in this transition, in any dramatic transition like this, that's a problem. So not only, I'd say it's a problem for two reasons. One is that behavioral patterns could change. So the behavior you saw in the pandemic certainly isn't normal behavior. It depends on how finely attuned your models are. Financial realities are more universal, but if you're looking at online spending habits, that is definitely not universal pandemic and not pandemic. And so you may need some time to gather new data to figure out the new pattern, or at the very least, you need to reset your intercepts to what the average level of risk is, because I think the pandemic data is not the correct level. So I'm just agreeing with you. Yeah.
So I'm not certain. I actually sort of find the whole situation being a little bit problematic. And in one way, one can take these sort of stress periods and use them as an overlay, where you say, okay, let's use the sort of most recent information as a baseline, but have an overlay for stress periods. And sort of effectively, Basel and the regulatory frameworks are saying, let's put in a floor, or at least for the capital requirements and such like. But the one thing that I remember was when we went through the crisis 2008, where we had relaxed all of our policy rules prior to that. And afterwards, the boss man came through and said, those policy rules were there for a reason. And 2008, we didn't have things like forbearance or any type of relaxation. The pandemic, all of a sudden you've got sort of the relaxation. So basically saying that the situation at the time can vary. The government or environmental reactions will change from one scenario to another. And you can't necessarily predict exactly how the authorities, the powers that be, are going to respond. Perhaps one might be assuming, or have to assume going forward, that should we get into a similar type of a stress scenario, that there will be the forbearance, but one cannot take that for granted. And perhaps the safest approach is to just assume the worst case, a la the pre-pandemic scenarios. Thanks.
Mm-hmm. You make some great points there, Raymond, that it can be from a regulatory perspective that you make a certain set of assumptions. That I agree that it's difficult to know in the next major event, would our government in the US or any government provide the same kind of assistance as we did last time? With the inflation we're dealing with right now, certainly some people take that as proof that we did too much. The counter argument is that there's inflation all over the world right now, regardless of what their government did. So there is a counter argument to that. But regardless, it's debatable. And so if our data shows one pandemic and one response, from a stress test and capital perspective, do we assume the same things? If we don't want to assume the same things, teasing those effects apart in our calculations is also challenging. Now, from a pricing perspective, that's a different question. And when it comes to pricing, and especially if we're talking about machine learning models that want to focus on the most recent data, that sort of thing, there is a lot of competition out there on pricing that is largely unregulated. And there, I think there'll be many different answers on how to use this data. The risk to everyone is a race to the bottom, because it always takes time before bad decisions play out in the market. So if people are making lending decisions that are priced too optimistically because they're looking at pandemic data, which is too optimistic, there could be some pain to come in the future, and it will require discipline to not follow. And I think to have discipline always requires data. I know this from personal experience, that if you give a forecast that looks bad, those things always lead to less growth, less revenue. So what you have to do, if you want senior leadership to agree to a plan of less growth, less revenue, you've got to have something pretty firm backing it up. So that's why we're trying to quantify these things as proactively as we can, because we don't want to cut back if there's no need to. But the flip side is, if there is a need, we need to know as soon as possible. So, and that actually gets to really my next slide here. How do you react to adverse selection? And so this is where I can tell you, back in 2007, when we were running these kinds of models and we were seeing this very high level of adverse selection, and this is before the market crashed, before everything went haywire, but we could already see poor credit quality. And I've talked to mortgage traders who have said to me bluntly, they didn't believe my models could have worked, because if they did, I'd be rich by now. And I've had to explain to them the difference between an analyst and a trader. I was an analyst for banks, not a trader. So I made no money off these forecasts, but the forecasts were right. And so I was speaking to a chief risk officer of a major lender and showed him the analysis. And he said very bluntly, yes, I know that's all correct too. We've been doing our own tracking, and maybe not with fancy methods, but they knew the risk was up there. But they couldn't get management. They said if they told management to stop mortgage lending, they'd be fired. So they were following the market, because they really didn't think they had any alternative. And that's where you need really an ability to push back. And honestly, before trying to push back, you probably need to have developed trust first. I will say there was a U.S. mortgage lender, this story is worth repeating at this point in time, where back around late 2006, no, actually, this would be late 2007, as we were talking to them about our analytics. They said they didn't have anything as fancy as we had, but they had some simple tracking that had already shown them, and they already knew. And so in 2006 and 2007, they had dropped to being not even in the top 20 in mortgage originations, and their top executives were upset about this and asked them to go create a plan on how to get back into the top 10. And they thought about this for a while. They studied the problem. They wrote a draft, and their paper on this plan, when they presented it, and this is the way they put it, they sat down for their meeting, they put the paper on the table and slid it across to the executives. It was one page, and it was one word, and it said survive. That they knew there was nothing they could do in that market that would book good loans at those prices. Their plan to become top 10 was to do nothing until the market corrected, come in at the correct price, and be top 10. And I think in that case, because they had trust with senior management, it actually worked, that they stayed out of the market at the peak of the mortgage bubble, let everybody else book the bad loans. When that bubble burst and the market reset, then they came back in and they went back to being a top 10 mortgage lender. That is not easily done. And that was an extreme situation. And I'm not saying that we're headed for a situation that extreme. But even subtle changes require data and trust. And so what we hope is that teams with data and trust can start looking at things like um, shifting the PD models to incorporate some adverse selection. This is like Leonard was bringing up, you know, even if you're using the pandemic data to train up a short-term credit score, can you adjust that a bit for some of the tracking that's happening with adverse selection so that you've got a realistic view on what your yields are going to be? And, you know, yield compression is a real thing. And if you want to run it closer to zero for a while so you can stay in the market, at least you know what you're doing. You may want to shift pricing a bit. If you shift too much, you'll take yourself out of the market and you get a different kind of adverse selection. So it's tricky, but, you know, be a little bit forward looking. And shifting underwriting standards, I often hear people say, in fact, just this year, I've heard folks say that they've had to shift their credit box because that 720 is performing more like a 690 or a 680, that you need to take into account that the PD versus score is not what it was before. And that's another way to look at it, is just change the bounds on your underwriting. So all of these things also, you should consider folding in risk of recession when you're looking at yield. I always want to know how much recession can you survive and still break even. So if you combine the risk of adverse selection in a rising rate environment and a certain amount of risk of recession, how close are you to negative? And, you know, it's not saying that you will lose money. Of course, at some point, there's some recession bad enough that we lose money. So you want to know what that threshold is. And of course, yeah.
Sorry, for anybody that has not watched the movie The Big Short, please watch it. I've watched it twice now.
Yeah.
And enjoyed it both times. So it really covers the 2007 and 8 subprime crisis excellently as an entertaining movie.
It's a good point. And what they found by going through file by file to get a feel for what kinds of loans are being written, we're just looking at statistically with all that data and asking, on average, are things shifting? And that was a case where you could see it from both perspectives. And of course, it makes a much better movie to show the case-by-case examples instead of talking about statistics. But yeah, it's an excellent movie.
So just to follow on that, in The Big Short, in the book, there's Michael didn't like most of the people that he met, but he did like Peter Schnall, who said, he was the chief risk officer at Capital One. And he said, we expect a recession at around every corner. And we build that into our decisions. And surprising, nobody at Capital One, but everybody at the regulators, Capital One, flew through the crisis unscathed.
Mm-hmm. Yeah, I think that is the way to do it. I think right now, you want to be balanced. You want to be rational about it. So a recession around every corner, plausibly, how soon would we see a recession with what we know now, kind of end of year, beginning of next year? If you're doing a short-term loan, 3 months, 6 months, that may not matter much. If you're doing a very long-term loan, you're going to feel that recession, but there's also a post-recession period. So mortgages, you know, you can look at what that would be like. Auto is always interesting because a 5-year auto loan is really a 2.5-year loan, and the peak risk is around 18 to 20 some months, and so that peak risk could land right in the middle of a recession. That could be painful. And the other risk with auto lending is that used car prices are high right now, and if you lend into that environment and then prices fall at the onset of a recession, your collateral is declining. So it's very much a product by product thing. But these are great comments, everyone. I appreciate how interactive it's been today. I have to point out, I do have to make a living, and we have software for this kind of thing, for tracking campaigns, projecting lifetime yields, and for quantifying adverse selection. So if anybody wants any assistance with that, let me know and we can help with that. As you know, the way I give webinars, that's the extent of my ad. But just wanted to let you know. Now, we do still have some time for open questions, but that's the extent of my prepared material. Anybody else have things they want to bring up?
So just a question, Joe, for the software that you've got, is it tailored to the United States or is it more generalizable?
It is general. It's software and algorithms. Now, in the US, we have a shared data pool, and that shared data pool actually extends to the Caribbean as well. Outside that, it means that you would have to bring your own data. Inside in the US, if you have a young portfolio or only a month or two of history, we can still offer a model. So when we work with folks outside the US, you bring your data and we calibrate with the same algorithms, but everything still applies. And as you know, Ray, we've been doing this for a few decades now. I've been in this industry for a while, and I've seen through many recessions and through many recessions in many countries, the algorithms do work. They are very generic.
Well, so specifically for mortgages, this, was in, I think your paper was 2018, or maybe it's 2016. But anyway, in any case, the regulators and the Fannies and Freddies and Ginnies of the world should know about this. Are they incorporating this kind of thinking into their decisions and their models?
It's an interesting question. I work with their data like many of us do, but I've never worked with them directly. So I can't really speak to what they incorporate in their models. I should say that the data that we can all get from Fannie Mae and Freddie Mac is not the full data of their portfolio through the recession. What they have done, and this is stated publicly, is that they took the data and filtered out loans which no longer meet the policies they set post 2009 recession. So they had a lot of loans prior to, I don't know when they did this, it was something like 2010. Prior to that point, they had a lot of loans which would not have conformed to the standard, and they performed badly. So I know if you get a broad industry data set like we did with the Federal Reserve analysis with Jose, that it shows much worse adverse selection than what you'll see if you look at modern Fannie Mae, Freddie Mac data, and it's because of that a selection effect. But that said, you can still see a strong credit cycle in the Fannie Mae, Freddie Mac data, even after that selection. And I should say, I didn't show it to you here, but credit quality in the Fannie Mae, Freddie Mac data is definitely reverting back, before the pandemic, it was reverting to, actually not reverting, but going to above average risk levels. So we were well past the last recession, and you could see that there was a return to higher risk happening back around 2019. We don't have pandemic era data yet, and of course we don't have, it'll be a while before we get data from them on what's happening now. But
I would disagree with you on that, Joe, because I was following the stuff that was being published by FICO, and there was according to their scores, it was a steady improvement in scores. And then the pandemic happened, and the information stopped coming out. But so I think you've got a reversion. It was abnormally good scores that were coming through in 2019. And I think that the reversion has gone the other way. It's gone from a very good back to greater normality.
Well, see, that's interesting, because when we look at their actual vintage performance at a given score band, we're seeing 2019 and 2018 being worse than if you go back to prior years.
Okay,
So,
I think so. When you talk about, I'm talking about the average scores that were being calculated.
yeah.
So there's
So,
a divergence between those two.
yeah, they could both be true. Okay. Well, everyone, thank you for your time today. And certainly, if you have any follow-up questions, let us know.